Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the Chief Strategy Officer here at OptionsPlay. And today I'm here to talk about a topic that is not widely spoken about, which is regarding market liquidity, regarding market makers. I'm going to dispel a lot of myths about how they work and hopefully give you some insights into how to source liquidity in the broader markets and some of the research that we've been doing to understand whether or not options liquidity has improved and how you can use the data to effectively get the most efficient fills or the fills with the smallest possible transaction price. So let's go ahead and get started. But before we do, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that we will discuss using today's session. So what I'll start off with is talking about some of the myths that I see with regards to market makers. So I'll talk about how I see traders perceive their trades are being filled, how it actually works on the back end as a market maker, and how trades are actually executed. And hopefully this will give you a better understanding about liquidity. And this is going to give you an understanding of liquidity from an open interest perspective and giving you insights as to how the other side works. And we'll talk a little bit about how options pricing comes about, because there's a lot of also misconceptions regarding liquidity when you take a look at options pricing. And then I want to share with you some of our research that we have been conducting to give you insights into where should you place your orders in order to maximize your probabilities of having your orders filled while minimizing your actual transaction cost on the trade. And at the very end, we'll open this up for Q&A. So let's go ahead and get started. But the primary thing that I want you to be able to walk away from today's session is a clear understanding as to how can I source the best liquidity when trading Canadian options. Now, before I jump into this, how many of you can generally relate to these current things on your screen? Because these are some of the things that I hear from traders quite commonly with respect to trading options, especially on the Canadian side. And some of you trade both Canadian and US options, but something I hear from a lot of times is, they're concerned that there's another party on the other side of every single trade. If I lose money on a trade, then the other party will make money. And many times when we talk about the other party, we're referring to institutional market makers. And liquidity represents how easy it is to find a party, another party willing to take the other side of the trade. A lot of comments that I get from investors saying, this particular stock or ETF doesn't have a lot of open interest. I'm concerned that I'll get into the trade, I won't be able to get out. So if any of this resonates with you, please type 1 into the chat window. Or if you say there's very little open interest or volume, I'm going to have a tough time getting in and out of the trade because no one's going to take the other side of my trade. If that resonates with you, type 1 into the chat window. Oh, I hope that the chat window isn't disabled. Let's see. I'm sorry. The chat window is disabled. Let me see if I can fix that very, very quickly. If I'm not, I will, you can use the Q&A window for now. I'm gonna see if I can try to get that fixed very, very quickly. 1 second. I apologize if I cannot get this fixed. I thought I can do that very quickly, but all right, I apologize, but it does not seem that I'm able to fix it very quickly. I will make sure we get that rectified before our next session. But I see a lot of users who had replied 1 in the Q&A window. So for now, we can use the Q&A window to respond, okay? So if any of you, can relate to that, this is fairly common in terms of a view. And, I know this because these are the types of questions that I get from customers. Why would you suggest an option with low open interest? Does the party who take the opposite side of my transaction make money when I lose money, or vice versa? And, who would ever buy or sell an option with low open interest? Because you would think that you wouldn't be able to get out of the trade, right? And that certainly would not be a position that anyone wants to be in. So this is something to consider here, because the other side of the trade from a market maker's perspective, and this is something that most traders never get a sense for, because market makers are inherently quiet about their business. They don't, they don't make a splash, if you will. So there's not a lot of information out there regarding kind of how the market making side of the business works, but they're really the side that facilitates your trading. So it's important to know. And hopefully this sheds some information and transparency on how market makers work, and perhaps shed some myths, if you will, that you might have regarding it. So if you think about the other side of a trade, a market maker wants your order flow. They want to do trades. The reason, because they have a lot of fixed costs to be a market maker. They have to there's a lot of computers involved. There's a lot of personnel involved. There's a lot of market data costs, exchange fees costs to be a market maker. They can only make back their expenses by doing as many transactions as possible. So they want your business. Keep that in mind. They want to execute trades. However, they're also not in the business of losing money. So they'll only execute trades where they can make the spread. The spread is the difference between the buy and the sell price. Now, that's what we have a bid-ask price for, and we'll discuss kind of what that means and where you can get filled inside of that bid-ask spread. But think of the bid-ask spread as an advertisement. They're on both sides. They're buyers and sellers. And the bid and ask quote represents where they're willing to buy and where they're willing to sell. And if they can make the difference between the two, they can match transactions, they make money. They're trying to make the difference between those two buy and sell orders. Versus you as a trader, you're trying to make money on the trade itself. They're just trying to make the spread. So you're playing two different games, remember, okay? And a lot of investors think that they're playing the same game as you. They're just on the opposite side of every single trade. And what you'll see here is that couldn't be further from the truth. So their goal is to maximize the number of transactions while minimizing their risk. Now, and it's important to understand that, yes, a market maker is on the opposite side of your transaction at the execution of the trade. So if you're long a call option, they're short that call option. But that's really where it ends. Where you remain long that call option, the market maker will effectively find ways to hedge that risk. So once they execute the trade, their goal is to offset that risk so that they don't maintain that risk anymore. So this is really where you have to understand the market maker and yourself, while playing opposite sides of the game initially. Once that initial execution happens, the two paths diverge substantially. And hopefully this gives you a different viewpoint into how this all works. So let's talk a little bit about how trades are actually executed. So they're trading against other positions, not just your position, because it's not like it's just you and the market maker and those are the only two parties in the whole market. You are playing against the market maker. The market maker is effectively trading against thousands of other traders. And just naturally across thousands of other traders, you tend to have orders that offset each other. So someone might be buying a call option, someone else is selling the call option. Market makers on the other side of both trades, but net on their books, they're hedged because one is long and one is short. Okay. Now, it doesn't always work out that cleanly. So there is more work for the market maker to do in between those two trades. But just keep that in mind, that naturally, as they trade against thousands of traders, there's a natural balance of the market. It's not like all traders are all long, so the market makers are all short. Now, that does happen. You have imbalances that do happen, but market makers will simply off their risk at that point. But their goal is to remain fairly neutral at the end of the day, right? So if, let's say, 1,000 orders come in to buy call options and then 900 orders come into sell options, their net is only 100 contracts long. And their goal at the end of the day is to do other things to offset that 100 shares, even though they've executed 1,900 contracts, 1,000 long and 900 short. But their net exposure is only the difference between those longs and shorts. And they only have to manage that smaller percentage of imbalance, if you will, at the end of the day. So hopefully that, first of all, just helps you better understand how the other side of the trade works. Now, if we talk about a single leg, right? Let's say you want to buy an August 360 call option. And let's say that call option has a 53 delta, right? So this is the call option that you're trying to purchase, an August 360 put option has a delta of 53. So if a market maker sells you this August 360 call option, you are effectively long 53 deltas and the market maker is short 53 deltas. The equivalent of being long 53 shares for you and the market maker is short 53 shares. Now, in order for the market, let's say that's the only trade that the market maker is on that given day for this August 360 call. So at the end of the day, you're still long the call option, you're effectively long 53 shares, the market maker is effectively short 53 shares. The market maker just has to go out in the open market, buy 53 shares of the stock, of the underlying stock. And now what they effectively do is they hold on to the short call option and the long stock position, but now they're hedged. So it doesn't matter if the stock goes higher or lower, they are hedged, meaning whatever they gain from the call option, they lose on the stock. Whatever they gain on the stock, they lose on the call option. So that is how a market maker is able to take the other side of the trade. They don't care necessarily if there's another trader that will come out here and take the opposite side of the trade to offset their risk, because they don't need another options trade to offset that risk. They can just buy or sell the stock to offset that risk. Does that make sense to everyone? Please type 2 into the chat window, into the Q&A window, if that makes sense to you. Because this is really where that myth of if the open interest is low and I can't get out is completely dispelled. Because as a market maker, it doesn't matter whether open interest is 1 or 1,000,000. The only thing that matters is their ability to buy 53 shares of this particular stock. If they can buy 53 shares of this stock, they'll execute that trade for you because they can offset their risk. They've made the spread between the buy and the sell price, or whatever the price that you end up getting filled at, and the price that they buy the stock. But they've effectively executed the trade. They've made their spread, and you've executed your trade. So keep in mind that the goal of you and your market maker many times may seem like they're opposing to each other, but they're really not at all. You have completely different goals, if you will, when it comes to sourcing market liquidity and getting a trade done. And if a market maker doesn't execute your trade, guess what? They don't have an opportunity to make money, but they still have all their expenses to maintain their market making operations. So keep in mind that a market maker has every incentive to execute your trade. They just obviously are not going to execute your trade at a price that they're going to lose money on. But as long as there's money to be made, their incentive is to execute your trade. Now that's a single leg. Let's talk about a multi-leg. Multi-legs are even better many times for market makers, because let's say you want to buy the 360, 380 call vertical. You want to buy the 360 and sell the 380. And let's say both of these legs have 0 open interest, 0 volume, but note how this is actually easier for the market maker to execute this trade, even though you're trading twice the number of contracts and both of them have no open interest, because the net delta between the two, you're long the 360, which is 53 deltas, you're short the 380s, which is 30 deltas. So your net delta on the two positions is only 23 deltas. So when you buy that call spread, the effective net position that you have on the stock is equivalent of being long 23 shares. And a market maker who sells this call spread to you is effectively short 23 shares. Now, the market maker, in order to execute this trade for you and then offset their risk immediately after executing their trade for you, only has to buy 23 shares to bring their net delta to 0. So their risk is effectively net 0 after they buy the 23 shares and they've sold you the contract. So think about it. What's easier to buy, 53 shares or 23 shares? Obviously 23 shares. And that's why multi-leg orders many times can actually get better fills than single leg orders, regardless of the fact that it has lower open interest or volume. None of that has anything to do with it. It all has to do with their ability to buy and sell 23 shares. If they can buy or sell 23 shares of this particular stock, they should have an ability to execute your trade. And hopefully that gives you a different insight that bid-ask spreads of the option, open interest and volume have no impact on a market maker's ability to execute your trade. It all has to do with how liquid is the underlying stock, and almost every single stock that has listed options on it typically trades at least a few 100,000 shares, if not a few million shares a day. So your ability to trade, even 10 lots of this where they have to buy 230 shares, a stock that turns over a few million shares a day or even a few 100,000 shares of a day, a market maker will have no problems buying 230 shares of that stock for you as a retail trader to execute a 10 lot order or a 10 contract order. Even a 100 contract order, 2,300 shares, should not be much of a problem. And this is really hopefully the information that I'm hoping to dispel and highlight for you, that this is what you need to be concerned about as a trader in Canada. So Sure is asking, but in Canada, you cannot do multi-leg options as far as I'm aware. So sure, you probably trade with a broker-dealer that does not offer multi-leg options. That does not mean that there are no broker-dealers in Canada that offers multi-leg options, because there certainly are. Interactive Brokers offers it, Questrade offers it, TD offers it. So there are multiple brokerage firms in Canada that offer multi-leg trading for both US and Canadian options. So when we look at volume and open interest, many times, you can look at volume and open interest, and sometimes it looks very sporadic. Sometimes it looks very robust. Some have thousands of open interest, some have thousands of volume. And sometimes I hear from investors that they'll be more willing to trade something with 600 contracts or 1,000 contracts of open interest, and they will avoid something like this, the 47s, because it has zero volume and zero open interest. The reality is that people like to trade round numbers. So it has nothing to do with liquidity. Open interest and volume is not something that you need to consider when buying or selling an option. It only matters is the number of shares that are traded on the underlying and whether or not the market maker can buy and sell the relevant number of shares to offset the risk for the trade that you are trading, which is effectively calculated in the net delta of the option that you're trying to execute. So if you're trying to gauge liquidity, don't look at open interest of an individual strike. Look at the open interest of the entire chain, because that gives you a sense for how many offsetting trades the market maker is making over that given day or over the period. Because like I said, they can offset a 53 delta call option with selling maybe a 47 delta call option, and now their net delta is only 6 deltas. They don't have to trade the same strike to offset their risk. They can trade any other strike, and they can offset partial of their risk by trading any other strike. They don't have to trade the strike that you are trading. And I cannot stress to you enough how many times I hear from investors saying, "Oh, I won't trade this 47 strike because there's no open interest." But it has nothing to do with offsetting that specific strike. They are only interested in offsetting their total risk of their entire book, not for each individual strike. So let's talk a little bit about options pricing, because the bid-ask price is the advertisement, if you will, from the market makers to try to entice you to execute trades. Now, here's the problem, is that if you think about the bid-ask price as the advertised price, sometimes this is very misleading, because you think that the bid-ask price is the price at which the market makers are willing to execute your trades at, because you think of markets as kind of one large auction, right? So the bid price is the highest price someone's willing to pay, and the asking price is the lowest price someone's willing to offer for a specific security. But the one thing that you don't have to consider that a market maker does is that they are making a market across thousands of strikes across hundreds of instruments. So keep that in mind. Imagine if you had to post a price that you're willing to buy and sell at across thousands of strikes and hundreds of symbols, that you have no control who is going to come into the market and take on those prices. Guess what? If you had to take on that kind of risk, you would widen out the advertised prices as well, meaning you don't really have an incentive to have really tight competitive prices on the screens, because if someone came out with, let's say, some kind of news event comes out and you didn't react fast enough as a market maker, you could be caught on one side executing a bunch of trades across hundreds of strikes or maybe hundreds of different symbols at an unfair price to you. So as a market maker, you are naturally shy in posting competitive quotes. And the reason that you do this is because you know any sophisticated investor who's trying to execute a large price, they're not just going to look at the advertised price. That's like walking onto a car dealership and paying the sticker price that's listed on the car. No one does that. You negotiate a better price. The market maker knows that anyone who's interested in trading anything of size is going to come in and negotiate. So the advertised price many times is just an advertised price. That's it. But what they know is that anyone who's trying to execute anything of size that's going to be meaningful for their business is going to come in and negotiate. And you as a retail trader should be no different. Just because you're only buying a single option doesn't mean that you don't negotiate the same way that someone who's trying to buy 1,000 contracts of that option. So what we measure here at OptionsPlay is not just the bid-ask spread. We measure what's called the effective spread. That's the difference between the execution price versus the mid price. So let's say someone comes in and offers a price of $7.90, and let's say that trade gets executed. What we look at here is the difference between the mid price and the execution price, not the difference between the mid price and the advertised price. And by looking at the effective spread and looking at where trades actually are executed, that gives you insights into how to place your orders. So we did a lot of research here, and something to point out that some of you may not be familiar with is the fact that in May of 2021, Susquehanna joined as a primary market maker in Canada. Susquehanna is one of the largest primary market makers in the US. They're Citadel and Susquehanna. They pretty much are a duopoly in market making in the US. And we know that the market making community in the US is by far the largest in the world with respect to listed options. So the fact that they recently joined in Canada in May of 2021 led to a lot more competitive market making in Canada. So I will agree with you that prior to May of 2021, the market makers in Canada weren't too aggressive in going after retail flow. They mostly were interested in attracting institutional flow. They weren't too interested in that in the Canadian retail flow. There wasn't too much retail flow to begin with, so they weren't very focused on that. Susquehanna, in the US, where retail consists of almost 50% of all volume, has a very strong business in growing the retail market space. So what we want to do is we want to measure the impact of liquidity before and after May of 2021. Now, we've been doing our research, but so far, we've looked through the top 15 symbols. We have the data for all the symbols. We're still sorting through this data. It's a lot of data. But what we started to look at is the average bid-ask spreads. One, they were reduced by about 15% from before to after May of 2021. So even the advertised price got more competitive in these names. And I think about 75% of the names that we looked at had tighter bid-ask spreads after May of 2021 versus before. But more importantly, like I said, bid-ask spreads is just the advertised price. It's like car dealerships listing a better price out there, but that doesn't really mean anything. What means something is really the price at which things are actually executed. And that's when we also saw a reduction. The average effective spread was reduced by about 11%. So you were actually seeing executions happen 11% closer to the midpoint price after May of 2021. So this is something that is a good news for Canadian investors, is that you're seeing better liquidity, and not only better liquidity, but executions that are happening at a price closer to what we call fair value, which is the midpoint. So we took this one step further. We wanted to measure, based on the bid-ask spread, where should you place your trades to get filled? And this is really where we did some research, where if you assume a midpoint of $1 and an asking price of $1.20, we wanted to measure at what point do you want to place your orders? Do you want to place it at 101, 103, 105, 110, 115? Where do you get filled? And when I talk to Canadian investors, the bulk of investors tend to believe that they need to put in their orders somewhere in this particular area in order to get filled. And you might have seen that before May of 2021. But what our research shows is that the average execution happens at roughly 58% of the way between the midpoint to the asking price or the midpoint to the bid price, depending on whether you're buying or selling. So what that leads me to believe is that if you are placing an order for a Canadian option, your best starting point is somewhere around the midpoint between the midpoint and the asking price, or the midpoint and the bid price. So in this particular case, that would be $1.10 if you're buying and 90 cents if you are selling. And you should be able to see fills very close to this point. Maybe you have to go a penny more or a penny less, but not much more. That means that you should not have to pay close to $1.20 or $1.20 in order to get filled. You should be able to get filled somewhere halfway in between the midpoint and the worst possible execution price. So hopefully this gives you some insights that the next time you are placing a limit order for a Canadian option, that you want to place your orders starting at perhaps just under 50% of the way between the midpoint and the asking price, or midpoint and the bid price, depending on whether you're buying or selling, and move maybe a couple of pennies off of that price, but typically not much more in order to get filled. If you're not getting filled, then in that particular case, it's probably not a trade that you want to try to execute at that specific price. So this is something that hopefully gives you some data points to help you understand how to source liquidity and how to get fills that improve your probability of being filled, and more importantly, reduce the impact of your transactional costs. Because the further away that you execute your trade from the midpoint, the more effective transaction costs you are paying, right? Because if you're paying $1.20 to buy and 80 cents to sell, you're paying a round turn transaction cost of 40 cents versus if you bought at 110 and sold at 90, that's an effective round turn transaction cost of 20 cents. You're saving about half of your total transaction cost on that particular trade. So that equates to $20 per contract, $200 for every 10 contracts. So that adds up. So really, you want to utilize this research to hopefully help inform your decisions, to improve your possibility of execution while reducing your transactional costs. With that, that covers what I wanted to share with you here today. I hope that this was helpful in giving you a better understanding of how to utilize the information that you were given today to place your orders. You can use the OptionsPlay tool, which is available to you completely free of charge, courtesy of the Montreal Exchange at optionsplay.com/TMX. I'll post this link into the chat window so that you guys can all see this. Oh, actually, I think I might have just enabled the chat window. Can you guys now reply in the chat window? Oh, sorry about that. Now I figured it out. I apologize. Sorry, I only managed to get that work at the very end. But like I said, you can register for a free account at OptionsPlay, and whenever you're using the OptionsPlay tool, which is designed to help you navigate and find opportunities in the options world. So whether you have a stock or ETF in mind, you can either select I'm bullish or I'm bearish and take a look at bullish and bearish strategies. But when you click on that trade button, think about the difference between the bid and ask quote here. Let's say it's 610 by 630. Excuse me. I would place my limit orders around, in this particular case, $6.20 to get started. That's going to maximize my chances of getting executed on the trade while minimizing my transactional costs. Does that make sense to everyone? Type 2 into the chat window if that makes sense to you, this example that I just showed you. You know, if you're buying, put in your orders around $6.20. If you're selling, put in your orders at about $6, halfway between the midpoint and the asking price, or midpoint and the bid price, depending on whether you're buying or selling. If you took nothing else away from today's session, that is arguably the most important piece of information that I can share with you here today. You know, if you're looking at 485 by 515, I would look at halfway between that, between these two numbers, which is around $5 to place your order to buy, and then in this particular case, about $4.70 to sell. So then your effective spread here is only 30 cents versus 60 cents in the original bid-ask price. You know, that's $30 per contract, $300 per 10 contracts. It really adds up in the long run. So this is really, really important information, and I'm really, really glad that my research team was able to dig into these numbers and give you this type of research and transparency so that you can get better fills on your options orders here in Canada. So at this point, what I'll do is I'll open this up for a Q&A. If you have any questions, type your questions in the Q&A window, and I'll try to answer as many questions as I have time for here today. There's a question about the symbols that we executed. So we are actually in the process of writing up a blog post. So what I can do is I can reference which 15 symbols we looked at. It's simply the top 15 options volume symbols that we looked at. I do have the research for all of the symbols, and I'm still working through that. And that's something we'll be able to share with you as well in the blog post. If I'm trying to execute a cover call trade, can you risk offering versus hitting a bid? I'm not sure what you mean by offering versus hitting a bid. You know, from my perspective, if you're looking to execute a cover call and you want to get filled relatively quickly, look at the bid ask price. So in this particular case, $2. This is a really wide bid ask spread. So you know, this is something that you can't avoid sometimes. This is for a $100 call option. So let's take a look at Shopify and kind of what options make sense. So it's currently trading at 44. So as you can see here, oh, excuse me. I'm looking to sell the September's $55 call options on Shopify. It's trading at 55 cents. Excuse me. The midpoint is 70 cents. I would look to cut this halfway here, so about 62, 63 cents or so. That's where I would try to fill my place my limit order, and you should get fills pretty quickly within that realm. I hope that answered your question. If you modify your limit price when the intraday trade is not filled, is it good to sequentially test the market makers' willingness to bite? Absolutely. So let's say you put in your order here at 62 and the market doesn't get filled. I would move it down to 61. I would move it down to 60. I would have a point at which I would stop doing it. I'd probably stop at about 60, right? I wouldn't go much lower than that, but I would certainly go 1 penny at a time to try to get filled. You know, I tend to see that if I'm not filled within a few seconds, I'll move the order, just because a market maker doesn't need more than a few seconds to, they probably don't even need, they need less than a second to react to your limit price and decide whether or not there's a large enough spread for them to make their money. So I usually don't place my orders for more than a few seconds before placing them and quote unquote testing their willingness to execute a trade, but absolutely. Market makers, you know, market makers are electronic now. There's no human there anymore. So are they seeing that you're trying to chase a better price? You know, it's hard to speak to how the market making algorithm works. Certainly there are smarter ones and not as smart ones. I think the smartest ones probably can detect the fact that, you know, the same size order is getting moved from one price to the next. But again, keep in mind that the decision to execute your trade has nothing to do with the fact that you are a retail trader and you're moving your order. It has to do with price, right? If 62 is just not a good enough price for them, as soon as you hit a good enough price, they'll execute your order. You know, these are computers making decisions, not humans. They don't have any problems with you trying to just work the order and get a better price. Ed, yes, the Canadian application is free, but you only can access Canadian securities. So yes, you can access the free version of OptionsPlay courtesy of the Montreal Exchange at optionsplay.com/TMX. And like I said, this is something that anyone can access, but it only gives you access to Canadian securities. Does the apply to ETFs rather than stocks? Yes, I will say that, you know, we haven't pulled the research on the ETFs. You know, I have found that the data is pretty consistent across different markets, meaning ETFs versus stocks from a market maker perspective. There's no difference in their ability to execute stock or ETF orders. So for that reason, I believe that to be the case. And you know, I'd love to hear your feedback. You know, take this information, apply this information to your trades, and let me know if you're getting better fills. Let me know if you're getting fills faster or getting fills perhaps at a better price than you normally would have placed your orders. I'd love to hear some feedback from you guys as well. Any other questions? If there are no other questions, I just want to thank you. I'm new to options, just wondering how to use OptionsPlay for cover calls. Great question. So there's an income tab here in the upper right-hand corner. And in the income tab, you will see a cover call strategy that will automatically apply an expiration date and strike price on your behalf. And you can then click on trade in order to execute that particular trade. But you can also use the income settings button. This way you can customize your cover call and short put opportunities that we present to you. You can choose short, medium, and long-term calls. You can choose conservative, optimal, or aggressive risk tolerance and save that as setting as default. So for any symbol that you type in, let's say you're looking at Canadian natural resources and you're looking to sell cover calls, this will automatically populate the September 78.5 calls for you and give you the risk analysis so that you can quickly compare it against the dividend yield and decide whether this is a cover call suitable for you or not. I have videos specifically on this one strategy, so hopefully you'll be able to take a look at some of those videos as well. Bid-ask prices change with the underlying stock prices, so can an order be outside the bid-ask limits? One, you shouldn't place your orders outside of the bid-ask limits. That's like saying that a car dealership has a sticker price of $15,000 and you're saying I'll pay $16,000 for it. You shouldn't do it. That's just, you know, you'll get terrible fills if you do that. You never want to pay more than sticker price. You always want to negotiate better than sticker price. And you know, you have to move your orders if the bid-ask prices change, right? Well, and bid-ask prices, once it hits a bid price or the ask price, your order will get filled anyway. But you should not place your orders outside of the bid-ask price. Okay, that covers what I wanted to share with you here today. Again, thank you so much for your time this afternoon. I hope that you find this information useful, and please let me know how this information works out in your trading. With that, thank you so much, and I hope you guys have a great trading day.